So diligencing emerging managers is much, much more challenging than diligencing a brand name high Roman numeral venture fund. There's just a lot less to sink your teeth into, and it takes more time and it takes more energy. If you meet with a lot of venture capitalists, much less a lot of emerging managers in venture, many of those managers start looking like each other. They tell a similar story. They're raising a similar amount of capital. They're focused on a similar part of the market. And when you see something that is different and it resonates with you because you think that it is contrarian good, which can be very close to contrarian bad, that's really when you start spending time. And that's where you start digging into the process of, do I want to actually invest with this manager?
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Courtney McCrea is the co-founding and managing partner at Recast Capital, where they back emerging managers who come from diverse backgrounds, where the delta between attention and opportunity is the greatest. Prior to Recast, she saw Fund 1s and through 4s at both Weathergage as well as Weston Presidio. We're going to get a lot more into that. And so while Courtney, I've heard you several times say, you say no more often than you say yes. As many of us in the world of investments do, we've got our backstage pass today to learn why and how she makes some of those decisions. Courtney is also a member of Venture Forward Board of Directors, Alzheimer's Association, Northern California and Nevada Board of Directors, and the chair of the Episcopal Impact Fund Investment Committee. That's a mouthful, but hopefully people caught that. Courtney, welcome to the show.
Well, thank you for having me.
There's a lot of areas in which we can start. And what I love about this podcast is really much of the name of it, Superclusters, draws inspiration from astrophysical concepts. So where 5% of our universe is matter and everything else is what we cannot see. So dark energy and dark matter. This podcast is dedicated to highlighting the thoughts and insights of my favorite LPs that are largely invisible to the human eye. So I want to start this conversation by going back into your timeline and talk about your time before Recast, much of which is likely to influence your thinking today. So you've led and founded incredible firms from Weston Presidio to Weathergage to Recast today, and you've clearly put in your 10,000 hours. I'm curious if there's a common thread behind each of these inflection points in your career.
No, I appreciate that. Now, just for the record, I have only actually founded Recast Capital, but I was a part of both Weathergage and Weston Presidio in their respective Fund 1s. So was a part of those teams very early. In terms of my experience in each of them, as you mentioned, certainly have come together in creating Recast. Because I had, amazing senior professionals that educated me on their craft. A lot of the venture business is a mentorship business. And so I learned, how to do due diligence, how to think about having proper investment judgment, how to do portfolio construction of a fund of funds and also a direct fund. And then really how to run a firm, how to hire people, motivate people, and be a good leader to those in your organization. In terms of transitions, when I left Weston Presidio, I had a really strong opinion about what made for a good growth equity manager. And I took those biases, if you will, with me when I went to the LP side and joined Weathergage. When I was at Weathergage, we invested both with brand name venture funds and also emerging managers. We were just looking for the very best managers that we thought could put up the best returns. And it was during my 10 years at Weathergage that I realized the importance of institutional investors having thoughtful institutional quality investments in emerging managers in venture. Number one, to get the return that everyone wants to get out of their venture portfolio. The emerging manager community is just so much more scrappy and hungry and raising right-sized funds. Not all emerging managers can put up exceptional performance, but you actually have the potential of having outperformance with these right-sized funds, with hungry, scrappy, networked with the entrepreneurs who matter, general partners. Number two, it allows institutional investors to see the pipeline of blue chip firms of tomorrow. And then finally, the emerging manager community is just so much more diverse than the incumbents.
That makes a lot of sense. I want to touch on something this phrase you just used, which is the institutional quality of investing in emerging managers. What exactly does that mean? Because I know what emerging managers are, like folks who are starting their funds and all that. And I also understand what institutional quality means. But the permutation of both of those phrases together, I am struggling to wrap my head around.
Is what it means is that I was trained at Weathergage. My partner was trained at Greenspring, as well as at the Clark family office. And in both those situations, we learned a very rigorous process of doing due diligence and how to do due diligence, how to identify which managers to spend time with, and then the work to be done in order to do a proper investment recommendation, think about proper portfolio construction, think about diversification by underlying industry, underlying vintage years, underlying iterations, fund numbers, diversification by geography, and to the extent you want it, diversification by investment stage. And so the way in which you go through the process of doing due diligence and the way you go through the process of managing your relationships with general partners, all of that is best learned, we believe, in an institutional setting, as opposed to just by the, seat of your pants.
And so when you learn how to do diligence on these emerging managers, obviously there's track record, there's like thesis fit, there's like, how much of their track record is portable if they were an angel or a partner at another firm kind of thing. What other things am I missing? I mean, obviously there's also the legal side, like what does the fund structure and all that look like? But is there anything I'm missing that is of note that you learned at, Weston or at Weathergage about diligencing emerging managers?
So diligencing emerging managers is much, much more challenging than diligencing a brand name high Roman numeral venture fund. There's just a lot less to sink your teeth into, and it takes more time and it takes more energy. If you meet with a lot of venture capitalists, much less a lot of emerging managers in venture, many of those managers start looking like each other. They tell a similar story. They're raising a similar amount of capital. They're focused on a similar part of the market. And when you see something that is different and it resonates with you because you think that it is contrarian good, which can be very close to contrarian bad, that's really when you start spending time. And that's where you start digging into the process of, do I want to actually invest with this manager? So usually these managers do not have that much of a track record. You are lucky if somebody leaves a brand name firm or they have an angel track record that has had realizations and up rounds. But you certainly are looking at, do I like this portfolio? Do I like that? Do I believe that they're a good judge of investment? Do I feel like they're making good investment decisions? And what is their decision-making process? If they decided to invest in company A, what made them decide to commit to that company and invest with that company? What value add, if I call up the CEOs, would the CEO say they did for them? Do I trust the person across the table from me? Do I feel as if there's somebody I can work with for the next, 10 to 12 years? Do I feel like they are representing themselves honestly and fairly? And do I believe that they have something that's unique, whether it is they see opportunity that others don't see, or they can add value in a way that I haven't heard very often. And yet I could see that would resonate with the entrepreneurs. That you could add you could help bring customers to them. You could help bring talent to them. You can think about talent in a different way. You could help them with PR and they value getting help with PR, whatever it may be. And perhaps it's something I haven't even thought of before. Often those are the more interesting venture capital funds, is when I'm enlightened to some need in the marketplace that I haven't heard from anyone before. And you spend your time we don't do reference checks until we already are sure that those are going to be confirmatory. We usually identify what we think the key, if we found this out, would cause us to not invest. You want to find the things that would cause you to say no and focus there early, because time is the most expensive part of what we have right now. And so, beyond money. And so, you end up saying, well, if I find out A or B, then I would walk away. We always do background checks on everyone we invest in. And frankly, everyone who goes through any parts of our business at Recast Capital, we do background checks. Usually that doesn't tell you that much. Is what's more interesting is doing confirmatory due diligence and a lot of reference calls, both on list and off list, to get a better sense as to this individual's reputation within the ecosystem.
When you're having these reference calls with people who are on list and off list, do you have a set of questions and criteria in which you are looking for when you have these conversations? And does it differ between those that are on list versus those that are off list?
Those reference checks are always bespoke to the opportunity and the individual you're talking to. And so you do your homework ahead of time. If it's a portfolio company, you understand what the portfolio company does. You understand the background of the individual you'll be talking to. Usually it starts with an open-ended question. How did you first meet this investor in your firm? And, what do you think of them? And keep it open-ended, and they will normally start talking and it'll go in a certain direction. It then bobs and weaves along the way as you've got questions that you have focused already around the risks that you're concerned about. If you're concerned about something, you bring it up in a very non-threatening way to try and see if they can either get you comfortable with that risk or they can mitigate that risk. And you also want to do confirmatory due diligence. If the general partner has said they are very much in contact with their entrepreneurs all the time and they add value in a very specific way, or this company is doing exceptionally well, it's up and to the right, you do confirmatory questions that validate all that's been told to you by the general partner. Because the one thing that is a real problem is if the general partner misrepresents who he or she is and what they have or haven't done.
I'm curious because in the world of time spent, you did mention that time. I would argue that time is our most expensive resource. Not like capital, you can always regain it at some point in time. But capital, I think time is a lot more expensive just because it's a resource we cannot get back. And in that world of time, the truth is that where you're spending the most time is with founders who are struggling, right? Your best investments are often they're flying, right? If you have, I don't know, like an Airbnb, Uber in your portfolio, they're up and to the right. And maybe not always, but like for the vast majority, they're up and to the right. And you're spending the least amount of time with your successful portfolio companies. How do you juxtapose that with when you have these conversations with founders? Do you confirm like, hey, you know what? This rock star company that they've backed, how much time do they actually spend with them? Because the reality of which they might not have spent that much time with them.
So it is interesting because most of the managers that we're focused with are really early stage investing. They're investing pre-seed and seed. Maybe you'll get some Series A if they have a follow-on strategy. And so at that stage, they're getting involved before the company is the Airbnb that we all know, before it's the Uber that we all know. So there's a lot of work to be done at that earliest stage, the earliest stages of these companies. And the best references, they scream it from the rooftops, the value that they added at the earliest stages of their company's growth and development. And they really believe in and want to support the general partners that did that. So that's what I'll say. First of all, and number two, I agree with you. I've actually learned more from my mistakes than I have from my successes. But there are different venture capitalists out there, even with the brand name firms. There are some venture capitalists that when the going gets tough, they walk away and they just write off the investment and they don't spend any time on those companies. I believe strongly that a 1x or at least returning invested capital is really important. Loss rate is really important. And so I do value when a general partner is taking the time to judiciously try and, take these failed businesses and make sure all the I's are dotted and all the T's are crossed before the doors are closed. So I do value that.
So switching gears a little bit, we'd be remiss not to talk about either the Accelerate program as well as the Enablement program for Recast. And you have 3 lines of businesses, which we talked about in our pre-chat. I have a question on the Accelerate and Enablement program, which is you were actually part of a very, very, very early cohort at Kauffman. And I'm curious how much of your time going through Kauffman's cohort 3, if I remember correctly, at a time where you had to join the fellowship before you found a place in the firm and not vice versa. How much of it has shaped your thinking about Recast Enablement as well as Accelerate's program?
Yeah, it's a good point. So I was part of Kauffman Fellows Class 3. My partner, Sarah, was part of Kauffman Fellows Class 23, which was a very different experience. When I was part of, my class had 13 people. We got to know each other extremely well. We also learned the basics of venture. So it's an apprenticeship business. We had mentors that were given to us who were at our venture funds. And we had sessions. It'd be here's a term sheet, and here's a lawyer from this institution, and they're going to describe what each of the elements of the term sheet are and why they're important. As an example, you had general partners come in and talk about their backgrounds and how they got to where they are. These are many of the same things we do with our educational program. It's just more nuanced because it is for emerging managers who are doing their own fundraising. When I was at Kauffman, we all went to brand name firms that had individuals who knew how to raise capital. These people are at the front lines of raising their own funds. And so our curricula for the educational program for Enablement, as well as the educational program for Accelerate, is broadly about fundraising, how to make your fundraising process more efficient, more effective, and you spend your time where you're going to get the most benefit. And so we bring in our friends from the general partner and the limited partner community to talk broadly about how to make your fundraising process more efficient, how to make starting your firm more successful. I could listen to emerging general partners who not that long ago were emerging, and now they've come out the other side. And yet they're reflective on what they did really well and they would do again. And those learnings that they had that they say, gosh, if only I had known this, I would not have done that. And some of those are really, really insightful. Likewise, we do a panel of LP archetypes, where we'll have a family office, a high net worth individual, perhaps a foundation. Occasionally, we bring in a public pension just to scare them, and we talk about, what you say you invest in emerging managers. Describe what emerging managers you actually invest in, and what you should look like in order to be meeting with me. And we talk very candidly with the folks that go through our program. It's all on Zoom. It's tuition free. We talk very candidly about. You got this feedback from an LP. What does that actually mean? What should you actually do with that kind of feedback? Or a question that you get that perhaps you were caught flat-footed because you didn't expect it. How do you respond to those questions? So we will normally spend the first hour doing a fireside chat with a GP or an LP or a topic expert. And then we will open it up to Q&A. And then it's just us with the cohort. And we talk about, were there any reflections on what you just heard? Any questions that weren't answered? Any questions you'd want my or Sarah's opinion on, or any questions you want feedback from the community? Then we open it up and say, does anybody have anything they want to celebrate or anything that they're really concerned about that they would like to share with the community? And then we will open it up to, what's top of mind? What questions do people have? I find the emerging manager community is so helpful to one another. Sarah and I certainly have some answers, but emerging managers who are actually in the field right now talking to all these LPs and doing all these pitches and raising SSBCI dollars, they have more real-time feedback that can be provided to this community. And I think it's an incredible asset. And so we try and foster the community around our enablement program. At this point, we've got 78 funds that have gone through our educational program, and we're just about to announce another 30, maybe more. And so we are actively working on creating opportunities for all the folks that have gone through our educational program to continue collaborating with one another, continue networking with each other, because I think it's an incredible asset that really should be harnessed.
How do you think about alumni staying active in the community? Because they've gone through the program, the lessons they needed in year one look very different from year two and year three. Like, how do you think about them coming back to contribute to the community or just being active in it?
So absolutely. We have had folks that have gone through our program 3 years ago come back and present within an existing cohort. But we've got Slack channels for each class and then for general. And they are still, some are more active than others. And over time, but we have just hired, who's going to be starting here in the middle of August, someone we're excited to share, not yet, who's going to be director of programming of events to try and make the community come together in bigger ways and to really make the alumni network more robust. And there's going to be benefit in, most of these managers that go through our program are raising their first institutional fund. And so there's value in continuing those relationships as these funds mature alongside you. And there's also good information that's coming from the managers that are going through the program now, because they have different lived life experiences. And so, trying to maintain those relationships, I think, is going to be really important to our brand.
I think so. And I know from the enablement program, you do the vast majority, if not all, your kind of curriculum on Zoom. But now that you're bringing in this new director of events and all that, how much do you think is going to stay on Zoom versus being in person?
So I continue to believe that this educational program is best served on Zoom. Number one, to be as inclusive as possible. These managers do not need to spend a bunch of money to get this content. And flying and getting hotel rooms is very expensive. Number two, I think of in-person events as being supplemental to the core curriculum. So we are doing our next cohort is going to be all individuals that are the beneficiaries of the Accelerate program, which is our nonprofit, which in addition to giving executive coaching and 6 sessions of executive coaching and our educational program, we will also be paying $100,000 of their expenses. And so we want that community to come together. And so we have the budget and the resources and the sponsorship that we are going to be doing an in-person event to launch that in Washington, D.C. So that will be our first in-person event that will be for all 30, 35 managers that get into the Accelerate program. We have had in-person events for the Enablement Program in Chicago, New York, and San Francisco, normally around a conference or an event when Sarah and I are both in town. A lot of emerging managers are in town, and we just do cocktails and hors d'oeuvres, and it's an opportunity for everyone to get together. We would hope that we'd be doing more events in person with everyone, and that's why we're hiring someone to help us lead that charge.
As someone who hosts events myself, I do agree that it is a full-time role and you can't half-ass it. As the famous Ron Swanson once said, don't half-ass 2 things, whole-ass 1 thing.
That's a great line.
Okay. You mentioned a little bit about the Accelerate program and the Enablement program. I'm actually curious that, are there different things you look at for someone who is accepted into the Accelerate program versus the Enablement program versus if you actually invest in them, right? Because between investing in amazing GPs who used to laminate notes so they could, study in the shower to one who turned a tour bus into a recording studio only to turn all the tracks recorded into a free compilation to hip hop fans, and a GP who builds their own internal AI tools to power fund ops. And these are all folks who have gone through your programs. How do you have you found any commonalities in fortune telling manager excellence before you invest in them?
So we do have different criteria for each of these buckets, although Enablement and Accelerate overlap more. For our fund of funds, we are absolutely looking for individuals that can see where the puck is going before others can, or they have a unique way that they can add value to what I call sort of overfished ponds. So you either are looking for opportunities in areas other people aren't. We have one manager who, as an example, they're taking legacy industries and they do a deep, deep dive into, say, the construction industry. And then they figure out where they believe technology could solve some issue that the construction industry happens. Or you might look into the construction industry and say, technology is not going to happen quickly here, and you move on to another industry. But then when you find the company that can solve whatever problem the construction industry has, they have a prepared mind and they're ready to invest. And other people maybe have turned that investment down because they thought the TAM, the total market size, was too small, or they didn't think that selling into the construction industry was going to be easy. And the work that you've done has shown that actually, if you could solve this problem, the sales cycle would be shorter. And so you can either go about it that way, or you can go to a very crowded space like AI or enterprise tech, and you can approach it with something that is valuable to the best entrepreneurs in that space. We backed in that category, we backed a manager who's focused entirely on enterprise tech, but their value add is real. And it was confirmed through due diligence, as well as what they articulated to us. They have relationships with the top Fortune 500 chief technology officers and chief investment officers. So they know ahead of time what these large institutions are looking to buy, what problems they are looking to solve. And then they will use portfolio companies or companies that they're thinking about investing. They will introduce them to these potential customers, not only for due diligence for them, but also it is a way to really add value. And it's logical that that CEOs early in their journey would value getting customers, really blue chip customers that they could put on their decks to raise their Series A or their Series B. So, and that's the point at which they're investing. So you need to have something you're bringing to the table that allows you to get with the best entrepreneurs in what is perhaps an overfished pond. That's the fund of funds. In the Enablement Program and the Accelerate Program, there we're only really focused on individuals that are raising their first institutional fund, or maybe they had one institutional investor in their prior small fund and now they want to take it to the next level in their next fund. And so that's a much more narrow archetype. And we want these to be individuals who it's logical, given their background and who they are, that if they do this, they will be successful, or they could be successful. And they have the right background to be a venture capitalist, and they have the right DNA and personality that with the right assistance, they could be great fundraisers. And so that's a very different archetype. And then when you also look at our Accelerate program is a nonprofit. So in addition to wanting more women and non-binary venture capitalists in the ecosystem, we want to see that the folks that we give support to are successful. But in addition, if there's an individual who is raising a fund that, it's going to be really hard for them to raise this fund. And it may or may not forever be successful, but we feel like given who we are and given what they are doing with their firm, we could add a lot of value to them. And they could end up being successful in their own way, not in a massive way, but in their own way and making impact on their communities that are being underrepresented when it comes to venture dollars. We'll take that on as well. We would not do that out of our fund of funds, but we would do that in our giving back to the community.
And that is why the enablement program is also tuition free, because you're increasing access, exposure, resources to folks who may not be able to afford. I don't know if that's the right term for it. These resources otherwise, either in terms of just like connections, relationships, but also of capital, because some of these, and I've gone around and seen quite a few emerging manager programs that get very, very expensive. That I've seen those that sit in the 5-figure range. And I'm like, I don't know if you're raising a $5 million, $10 million, $15 million fund, if that is something that's, worth putting dollars behind before you raise it.
So some of those organizations are recognizing they have an issue, and they've got groups of people that are trying to solve that. Because if you really want to focus on the emerging manager community and the more diverse emerging manager community, they cannot afford an $85,000 check. They just can't. And at the same time, the services they need are also a little bit different, right? So there's value in getting their pitch fine-tuned having their pitch be the best it can be, having their deck be the best it can be, having them focus on the right types of investors for their size fund and for their strategy, is really valuable. Introducing them to those LPs, even if it's just in a casual way, is really valuable to them. It's less helpful for them to be meeting with the blue chip LPs in venture funds because they're not going to be investing with these groups of managers. It tends to be corporations. It tends to be family offices. It tends to be high net worth individuals, some foundations, some mission aligned foundations.
Nevertheless, you still decide to scare them with the pension fund on the panel.
Occasionally, yes. Well, because a lot of pension funds say that they invest in emerging managers. And then when you actually look at what they invest in, they'll back the spinout from Sequoia or the spinout from General Catalyst. And yes, that's technically an emerging manager, but it's not really helpful to this community.
Do you ever have on your panels, and this is going on a tangent at this point, but do you ever have the LPs, whether it's high net worth individuals, family offices, or these pension funds, share how do you define an emerging manager? Because I imagine the definitions will vary across the board. Because as you mentioned, pension funds, they might be investing in an ex-partner at Sequoia, but that's not really the typical emerging manager you're looking at.
So, don't get me wrong. For our fund of funds, we're happy to take spin-outs from established firms. And they are still emerging managers because unless you were the founding general partners or the managing directors, you maybe were less involved in the fundraising and the day-to-day of the firm. So there's still, the scaffolding that goes into raising a first-time fund. They still have some of those challenges. And so we still think of that as an emerging manager. Also, there are some individuals who leave Sequoia and they feel like they still have the Sequoia magic cape, if you will. And without the Sequoia business card, perhaps you're not quite as impressive with the entrepreneurs as you once were. Sequoia is a bad example because you probably all have individual great brand names, but you get my point.
So you mentioned red flags earlier. You may not have a scorecard, so to speak, for checking off emerging managers of they've got to have this and that and that. But on that wavelength of just the red flags, do you have are there different red flags that you would have for folks entering the enablement program versus folks you have that you invest in as part of the fund of funds?
So I'd say the one overarching red flag is overstating accomplishments, embellishing where you are with your closing, embellishing who the LPs are that you've circled or soft circled. Those are deal killers. So is if I do a background check and I tell you I'm doing a background check and you haven't already told me the reason why you had that felony, those can be red flags. Not that you had the felony, but not having disclosed it or not coming forth when I do find it is important. I would say for our educational program and for Accelerate, you don't need to have this, but for the fund of funds, you need to have a really thoughtful and articulate portfolio construction, follow-on strategy, how you are adding value to your companies, why you're the right person to pursue this strategy, why the fund size that you have on the cover is the right fund size for what you're pursuing. You have some answer to the question of what do you want your firm to be over the next 20 years. And so all that does not need to be fine-tuned when you're going through our educational program. In fact, our educational program helps you to make all of those pieces come together better.
How do you think about succession planning? Or have you heard about some thoughtful responses to succession planning, if that is something you might look for? Because I imagine most emerging managers are this is my brand, this is my fund, right? But they don't think of the ones that I've talked to, they haven't thought as deeply about who takes on the reins. Does the fund's legacy outlive my own legacy?
So a lot of these managers are in their 20s or their 30s, so maybe it's less of a focus there. But I think there's not a right or a wrong answer. I think it's having an answer and having a well thought out answer. There are those entities that say, the right size fund for me is 75 million, and I don't want to have a lot of colleagues and junior people walking around. I can do that with myself and a partner. Over time, I want to have another partner, and we're going to be equal partners. And, when it runs its course, it'll run its course and we'll be done. That to me is a reasonable answer. Obviously, I want to see that they're going to be around the table to make sure everything gets settled in these funds. But I'm okay with that answer. If somebody's vision is they're going to create an empire and they are going to have lots and lots of people, venture partners, an operating team, they're going to have a stable of general partners and younger partners who are out finding deals. That's just a very different archetype. And so you need to really understand why they're the right, are they good managers of people? Are there enough opportunities to have this massive organization focused on whatever you're focusing on? I mean, Andreessen Horowitz is a good example of that. I mean, they've done an exceptional job of creating a very large institution with functional areas and relationships that come from those directional and value add that comes from those different areas. So, but it's a different due diligence process to get comfortable with that type of a model versus getting comfortable with somebody who's going to keep the right same size fund and not really grow it.
That's really interesting. I want to flip as we're rounding out here. I want to get into some more lighthearted questions, and we might play some hypotheticals here. You've once written about the 1% GP commit. And admittedly, the 1% GP commitment to their fund is an arbitrary measurement that I believe is a relic of some tax law in the 1900s. And so you did write about in this, I forget where you wrote it, but I want to say TechCrunch, but I might be misattributing there. While 1% may not be a meaningful number to independently wealthy GPs, it is very meaningful for less independently wealthy individuals, right? So I'd love to play a little game. I'm going to share a couple hypothetical scenarios of GPs' backgrounds and their fund size, and you give me the rough range of what you think 80% of managers with that profile should be in terms of GP commits. So I will also warn in advance, I'm a big fan of flavor text in card games and Pixar movies, so there will be some information that's superfluous. So, you ready?
I'm ready.
Amazing. Okay, so I want you to close your eyes for a second and imagine we're in the wonderful world of Zootopia. A young fox has recently graduated from Zootopia University, one of the best universities in the boroughs. And she had worked 2 part-time jobs in order to pay for college on top of being a student body president, supporting a wide range of entrepreneurial initiatives on campus. Now, she wants to raise a $10 million fund. So in your mind, what seems like a fair number to expect from her in terms of a GP commit?
I think she should talk to a tax professional and then pay nothing in her GP commit. And her pitch is, I'm not getting wealthy off the fees of a $10 million fund. I have an opportunity cost not working while I'm raising this fund and while I'm investing this fund. And you will never find a general partner who is more deeply, deeply aligned with you than me investing this $10 million fund. Because if I do not invest this $10 million fund wisely, I'm never raising fund 2. Or if I do raise fund 2, I'm never raising fund 3. So I am deeply, deeply committed to making this a wildly successful fund 1. And that's what I would pitch for why I have a 0 commit, in addition to the fact I don't have the money.
That makes so much sense. I love it. I love how articulate that is as well. Okay. I want to switch gears a little bit, zoom out of Zootopia, and now we're into the world of Paris, the city of love. Remy, a young restaurateur, has made a modest living running a small but very popular cafe in the heart of Paris. And so he has an annual income of low 6 figures, but now wants to raise a $25 million fund to invest in scalable businesses, scalable restaurants. How much do you think Remy should be putting into his fund?
So Remy should be putting in a GP commit. Remy should probably do the math on his expenses, his budget, and how much he's going to be able to pay himself over the next 5 years, and how much of that income he needs to live off of. He also needs to look and see what he has in the bank for unexpected events. And I think you could make an argument for anywhere between 25 to 50 basis points up to the full 1%, depending on the answers to those questions.
Gotcha. Because he does make a living, has a 6-figure salary, and if he's betting on this, it's also an opportunity cost, but it's less of an opportunity cost than the initial example with the fox from Zootopia. All right, last one. Lastly, we have Queen Elsa. She comes from sovereign wealth and naturally is independently wealthy outside of her fund. After her experience harnessing the coal that never bothered her anyways, she wants to start a $100 million fund one to back entrepreneurs harnessing nature's elements for humanity's prosperity. So as an LP, what do you think makes sense for her to be putting into the fund before she starts raising outside capital?
I would believe that she, given her piles of money, if she really believes in this, she would be putting a meaningful amount in this fund because she believes in it as much as I do as an LP. So I would think that she would come in at 4 to 10% of the fund.
4 to 10, that, okay. I mean, she does have a lot of cash, and I imagine, like, if she really wanted to, she could probably fund it entirely herself.
There are many people, by the way, that say that they don't understand that that general partners raise outside capital, people who are from outside of the industry. And as what I say is, general partners tend to be a very smart group of individuals. They know better than to just use their own capital.
We chatted a lot about mistakes when we were last recording. And with founders, they can do everything right and still fail, right? And Hunter Walk at Homebrew has this great line. I'm going to read it so I don't misrepresent it. But he once said, never follow your investor's advice and you might fail. Always follow your investor's advice and you will definitely fail. And a couple episodes ago, we also had Beezer on from Sapphire, and she talked about she underwrites risk, underwrites to 3x net steady state for Series A funds, 5x for seed stage funds. And this corroborates quite well with industry, the industry among established LPs, underwriting 3 to 5x multiple before investing. But all that preamble to say, we as an industry talk a lot about lessons from failure and from mistakes. And we did so as well earlier in this conversation. But I have a question on the flip side of the spectrum. For you, I am curious, what do you learn as an LP when your expectations for a fund are exceeded?
Yes. So when your expectations are exceeded, it's a wonderful thing. But just like when you underestimate failure, it's a time to be reflective. What made this manager so fabulous? How could that become repeatable in other managers that you talk to? How can you take your learnings for why that manager was successful and apply it to your later investments? It just makes you a better investor. And sometimes it's a very hard process to do. You need to, ideally, when they're raising the next fund, you're talking to their founders and you're saying, why is it you wanted to work with this venture capitalist? And what did they actually do to help you? And sometimes the answers to those questions become more apparent through those conversations. We had, when I was at Weathergage, one of our best performing managers were 2 general partners raising their first fund, and they fought in front of us every time they were across the table from us. And there was a rough rule of thumb that you don't back 2 partners that are always fighting and quarreling and disagreeing with one another at the same table that an investor is at. And yet they ended up being, if not the best performing fund that we backed, it was pretty darn close. And so you have to go back and say, well, how was that, the disagreements they had in front of us, how was that helpful to their partnership? And upon reflection, you said, well, they weren't actually angry with one another. It was more that they were pushing the boundaries for what the right answer was. And perhaps that kind of back and forth is actually helpful to better decision making. And so going through that process of understanding why you made the investments you did, what you believed would happen, was that accurate? Or did it exceed your expectations? If it exceeded your expectations, why? How were they able to get into those companies? How were they able to have a better spidey sense as to which companies were going to be the ones that outperformed? But it's a lucky problem to have.
I imagine so. I imagine there's also this level of intellectual honesty and candor in which they are arguing in front of you. I assume the reason you invested in them was not because they were arguing, though. It's because of so many other things. So I'm curious, and we can edit this out if this doesn't work. But was there something about that set of fund managers that were arguing that was really right, in a sense that you knew you had to back them despite seeing them argue at a meeting?
Every single investment has risks and it has opportunities. And so in this particular case, that was a risk. But there were so many other things that were up and to the right that were really, really positive about the background of these general partners, about the areas that they were going to be investing in, where they were finding their companies, how they were adding value to their companies. But if you don't have risks in your due diligence, it means you haven't done enough work, because there are risks with all investments. It's just whether or not they come to fruition.
That makes sense. Actually, I wrote a blog post last year called The Emerging LP Playbook, which actually touches a little bit on this, but it was inspiration from Chris Duvos. I want to attribute this to Chris Duvos, but I might be misremembering this. So our audience can keep us honest. But what he effectively said is when you do reference checks, you don't want effectively unanimous agreement of this person was a great person, right? Having some level of confrontational ability shows that they have the propensity to be wrong and alone. They aren't scared for speaking their mind and making honest decisions. And I'm paraphrasing there, but I think Chris or whoever said this, worded it much better than I did.
I would agree with that. I mean, one of the other really great managers we backed at Weathergage was an individual who said, I'm not going to invest in the mainstream geographies. I'm not going to invest in the mainstream industries. I believe that I can find great investment opportunities outside of those areas, and I'm going to become a deep domain expert in these other industries or these other sectors or these other geographies. And I'm going to put up exceptional performance because I had more of a prepared mind and I was willing to look in places that other people weren't. And he ended up putting up exceptional performance.
All right. I want to close this out. We are on the last question, but I want to come full circle here. I mentioned at the very beginning that at Recast and as an investor, we say no more often than we say yes. But for the sake of the next few questions, I want to hear you say yes more than you say no. We'll see how it actually turns out. I'll have my counter ready for this. But I have 4 questions. 5 questions actually on this front. So, you ready?
I'm ready.
All right. Should more LPs invest in more emerging managers?
Strong yes.
I love it. Second, should Nancy Pelosi and Dianne Feinstein show their support for FDA-approved treatments for Alzheimer's?
Absolutely yes.
Should more firms be RIAs, registered investment advisors?
This is where, sadly, I have to say no. I think it is an onerous process to become an RIA, and it is a limitation to emerging managers' success.
Okay. That's our first no. Hopefully we can keep our streak strong. Okay. Is LPs buying stakes in general partnership as opposed to the fund level limited partnership a trend here to stay?
I certainly hope not.
And I have the last ultimate question, the hardest of them all. And I want you to think really long and hard here, all right? Because your answer will single-handedly determine who is friend and who is foe. So the question is, should pineapples go on pizza?
Yes, they should go on pizza, especially with ham.
Wow, okay, all right. I don't want to create any enemies or frenemies or pick a side here. I'm going to play Switzerland, but that is a very interesting response. If I'm right, that was 3 yeses and 2 no's. So I'd say we're making progress.
Agreed.
Well, absolutely awesome. This is the end, and we've come full circle already. Courtney, I've learned so much from this conversation. I know our listeners will learn a lot from this conversation. If people want to find you, where's the best way to find you? Because I know you're on all the socials and you have your email, but where do you prefer?
Email is always the best way to get in touch with me. Courtney@recastcapital.com. Thank you for having me, David. It's been a pleasure.
Absolutely. Take care.
You did more research up front than anybody I've ever seen.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are 2 completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for 2 reasons, the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist. And I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up. And as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, John, you're free to stay here for as long as you want. And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, you cannot manage what you don't measure. And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, Moengage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. They're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.